Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford, one of the managing partners over at PassiveInvesting.com. And with us today, we have a special guest, Brian Wagers. Brian, welcome to the podcast.
Thanks for having me on, Dan.
Awesome. Well, I would love before we start to dive into this Morgan's Landing asset over in Porte, Texas, 350 units. Before we dive into that asset, talk to us a little about yourself and your background and kind of where you are right now in the multifamily space.
Yeah. So right now I'm a partner with Elevate Commercial Investment Group. You may have heard of us. George Abreu is pretty active on social media. He's our CEO. I got involved with Elevate as of last year to come on as a partner. Before that, I was doing multifamily on a smaller scale by myself. So 6 years ago, I got started with my first 12 unit, and I did that 100% myself. I got a 20 unit seller financing, then another 12 units. So I built up a portfolio of 70 units where it was just me. I was 100% owner, kind of small multifamily, and then after that, my father-in-law wanted to get involved. So he was the equity and I did everything. And we built up a portfolio of about 500 units, anywhere from 82 unit apartment complexes to like 7 unit apartment complexes in my backyard of Northwest Arkansas and about an hour south of me in a market called Fort Smith, Arkansas. So I was doing that for about 5 years, just taking down these medium-sized, small, under-the-radar apartments for a while, just on my own. And then about a year and a half ago, that's when I realized there's only so many doors in my backyard of Northwest Arkansas. And for me to really go bigger and scale up, I had to, get with a bigger company and look at other markets besides Northwest Arkansas. A syndication was always in the back of my mind to continue to grow. So that's a little bit about, my kind of trajectory to where I'm at today.
Awesome. Well, let's go ahead and dive straight into this deal called Morgan's Landing over in Porte, Texas, 350 units. Talk to us about how you originally kind of sourced and found this deal.
Yeah, so we have quite a bit of properties in Houston, Texas. So Porte has kind of been on our radar too. It's just outside of Houston, very high income area. And we were going after this project. It was straight from a developer, A-class project, which we have gotten more bullish on the past 18 months. And we were going after, it was listed. And we found out there was another partner that we had talked about, possibly partnering up with in the past. They're kind of a competitor of ours, and we knew they were going after the asset as well. And we reached out to them to see if they would want to partner up with us. They're a much larger fund than we're pretty sizable, but they're a much larger fund. And we thought they might have told us just to kick rocks, but they had a lot going on at the time, and they wanted us to kind of lead the project. They bring on the majority of the equity, but wanted us to lead. So we, instead of competing against each other, we decided to partner up on the and go after it together. So we ended up forming an agreement there.
So you guys are still the main operator on the project. They're just kind of primarily bringing in the majority of the capital for this project.
Yeah, exactly. They brought in about 80% of the equity.
Okay. And how did you structure that with them, as far as kind of like how did you kind of come up with like who does what and who gets what and stuff like that?
Yeah, a lot of legal work, a lot of redlining. Working with a fund that size, it was definitely a ton of back and forth. Which it's exciting to work with a big firm and the large check, but there is definitely some control you give up in that. So there's some give and take with those larger checks, but we ended up we took control over the asset management, capital call, like any capital events. It's a joint voting right there. It was just kind of a lot of back and forth with legal on that, but we ended up taking majority of the control, but they do have majority of the equity.
Mm-hmm. Okay. And So from once you first heard about this deal, I'm assuming you got it from a broker since it was listed. At what point in time did you kind of go in and decide that you were really wanting to move forward with it and start to actually put some more time and energy and effort behind it to go actually do some of the on-site due diligence, whether it be touring the property or even putting some more pencil to the paper for the underwriting side of things?
Yeah, for sure. So it hit some of our check boxes. You know, we liked the market. We liked the asset itself. We liked that it was straight from the developer. There was opportunity to stabilize expenses and push market rents there. So we saw that opportunity. It's a 2021 build. So we were getting it straight from the developer, and it checked those boxes. The quick, you know, back the napkin math, it made enough sense for us to do what you said, you know, do a little bit deeper dive and get out to the property and really take a fine comb through the underwriting.
Yeah, good. So once you guys decided to put an offer on this thing, how many rounds of offers did you end up going through on this one?
That's a good question. I think there was 3 rounds. I wasn't as involved on the acquisition of it, but I do remember there being pretty close to 3 rounds on it.
Okay. And at what point in time during this entire process did you end up touring the facility?
After the first round, we went out to the property. We're in pretty active in Houston, so we had someone go down there and check it out. And then we actually had it was Eric that went out to the property after the first round. Someone from the actual general partnership team went out there after the first round. But before that first round, we had one of our property managers check it out.
Mm-hmm. And what was it originally listed for? Or was there a listing price?
Yeah, there's more of like a whisper price that they were trying to get to, which was 73 million.
And what did you end up putting it under contract for?
73,250,000.
Okay. And when did you close on this one?
We closed August 16th.
Okay, so very recently.
Yeah, this was our most recent close.
73.25 million. And walk me through the kind of the terms of the offer, as far as like the amount of earnest money deposit and when it goes hard, and also kind of the structure from, you know, number of days for due diligence and time to close and any extensions and things like that.
Yeah, so it was originally a 60-day close, 30 days of due diligence, another 30 days of financing, and then we had an additional opportunity to buy an additional 30 days for, I think it was $500,000 for that additional 30 days.
Okay.
The initial earnest money was 1.5 million for the earnest money deposit there. That did not go hard until after due diligence. They did ask for us to try to make it hard at day one, but we were pretty adamant about it not being hard until after due diligence.
Sure. So 30 days due diligence, 1.5 million earnest money deposit doesn't go hard until after the 30 days. And going back to this other group that you worked with to bring in 80% of the capital, did they give you a commitment by the time you were done with that due diligence process to give you some confidence to move forward with this project?
Yep. Yeah. Like as we were, I mean, we had that commitment before we finalized the PSA.
Okay.
We were definitely wanted that before we even got into due diligence. So, you know, after due diligence, part of it was, you know, going through some of the redlining that I mentioned earlier, like fine tuning, but we had the, and they put up the majority of that risk capital as well. So we felt confident there in their ability.
Sure. So you guys basically were able to put it under contract already with this other group, giving you a confirmation they're going to do it. And walk me through how that worked for you. Was there some form of like, obviously you're saying they helped out with the risk money, but was there something in writing that they were going to commit to the project, or how did that work?
Yeah, we had, I mean, they're a pretty large fund, so they didn't have to actually go out and raise the capital for that. They actually had the capital already sourced. We felt confident there. But it was some emails, some verbal confirmations, and then putting up that first initial majority of risk capital. Nothing had been solidified until we were still fine tuning the legal documents until we actually closed on it. But we had a good idea of what that would look like. We had our initial kind of term sheets for each other before that we finalized that piece.
So of that 1.5 million, the amount that they put in, if they went past the due diligence period, they would lose out on that money if for some reason they didn't complete the transaction.
Yep, 100%.
Yeah. And that's kind of the biggest kind of, question mark, I think, a lot of times when you're working with some of these other larger kind of institutional style groups, is that, number one, a lot of them don't like the risk capital as far as, any money that goes hard, right? Especially the initial hard money. And then it's also harder for them on that initial earnest money, but also on whenever you're it's going to actually go hard, right? And then they sometimes don't even want to give you a commitment until they're ready, and they might not be ready by the time you want to put it under contract. And so there's a timing issue, and then they could pull out all the way until the day of closing if they wanted to. And now you're stuck kind of holding the bag, if you will, if they haven't actually participated with some of that risk money.
100%. Yeah, that's true. The more we're looking at working with the institutional partners, a lot of them come in later in the process. They were ready to do the deals themselves in the beginning too. So they had, I think, an extra layer of comfort with the project. And I think that kind of helped. But like you mentioned, you do have a lot of institutions, not ready till, after that earnest money is hard, because they have to go take it to their board. They have to get it approved for their credit underwriters. And then from there, they have to take it to a board to get approved. And they like to see that you have risk capital in the deal too.
Now, did they also participate in signing on the loan?
Yeah, we signed on the loan. We signed on the loan with them.
Okay.
They actually chose the lender. They actually had control over that too, on the debt.
Okay. And of course, with them being the biggest check writer, I'm sure that was one of those levers that they could pull. And I mean, it is what it is. It's really kind of the majority of their money that's at risk there.
Exactly. Yeah. So we were fine with that.
Yeah. So what kind of, issues came up during the due diligence process? So we got it under contract now, got all the terms finalized, got the committee, got the equity, majority of it committed for. So what other issues came up, or any issues, since it's a brand new asset? There might not have been any, but what kind of issues, maybe came up during that due diligence process, whether it be the physical side of the due diligence or the financial side?
Yeah. So like you mentioned, I mean, it's built in 2020. It was finished building in 2021. So even though it is an A-class, we had all the line scope. So that's something that we're doing with every A-class property, because sometimes, just because it's new, sometimes they don't build it right. So, but those all came back good. Lines were good. Financial due diligence came back good. One thing that got scary was insurance quotes. They were all across the board. Being in Houston, you can get pretty wide range there. So at the final minute, we underwrote for a higher insurance rate per door than we actually got. So that actually turned out well there. But that was a big, like one of our go-to insurance providers came back. He was like $400 a door higher than what we initially thought. But we ended up finding a new provider there. So that was big on that side. But the property actually, as we had it under contract, it was trending up all the way to close. So by the time we closed, we were pretty close to our year one pro formas. Because again, it's a new build. They were still in the process of pushing rents. These developers, their whole goal is just to get it leased up as quickly as possible so they can cash out and go move on to the next project. So they did that in the initial lease up, but as we were getting closer to close, we actually had a contingency. We wanted to get involved in the operations after our money went hard. We wanted to push rents, so they had the extra layer of comfort knowing that they had $1.5 million hard, after that. So we went to them and asking, after this goes hard, we would like to, push rents on some of these. So, by the time we closed, we actually had a great trajectory taking over, almost hitting year one performance.
Yeah, that's great. How did you guys end up financing this deal? I know you said you used the lender that was selected by the other group, but how did the lending shake out on this one?
Yeah, so we actually used a bridge debt on it. I think it was 67% loan to cost, 5-year, 3-year fixed, 3-1-1. I think it ended up being 415 basis points over SOFR.
So probably close to like what, 6.5?
Yeah, I think it was right around 6 on that.
Okay. Any prepayment penalties on that one or lockout periods?
First 3 years lockout, I believe.
So you cannot refinance in the first 3 years, or then 6 months of the end of the 3 years, or
I believe it was 6 months within the first 3 years.
Okay.
6 months of that.
Okay. And what was the decision to go with bridge debt versus maybe say a agency financing company that, obviously you probably can't use agency because it probably wasn't 100% or not 90% plus occupied, but other types of, debt options that were out there.
Yeah, we were open to different financing strategies. The fund on this one, they wanted to do the bridge loan, and we actually didn't do a rate cap either. We had a interest reserve, like almost $1 million in interest reserved, and they were under the impression that within the next 3 years, they don't see the interest rates, they see them stabilizing after the next 12 months. So I think the rate caps by the time we were close to closing were in the 7 figures for this one. So they decided not to do a rate cap and to do the bridge. That was kind of in their decision on the debt side.
So what would be the purpose of the rate cap if there's no floating rate? Because you mentioned this one being fixed.
You're right. It was after the 3 years exactly. So that was a question I think we had on one of our webinars. It was like, why not have a rate cap? Because they were starting to be more common as we got closer to close. When the interest rates environment, the whole interest rate market shift kind of happened as we got under contract, and definitely some people were taken aback. That was definitely a learning moment on the capital raising side too, where we had people ready to go prior to this, but right when the interest rates kind of jumped and did their thing, we had a lot of people kind of sit back and want to see what happens with interest rates. And but thankfully we were able to use that extra extension on it to get it closed.
Mm-hmm. Yeah. So on as far as the rate cap is concerned, maybe you guys were originally going to do a floating rate and then you guys switched to this fixed rate bridge debt. Is that kind of what happened?
Yeah, that's it. Pretty similar. Yeah. So I think we were looking at doing floating versus fixed rate, but ended up doing that 3 year. Okay.
So 3 year fixed, and then does it convert to floating after 3 years?
Yeah. Two 1 year, it's like 3-1-1, I think is what it was.
Yeah. So 3 years fixed with 2 1 year options to extend, but then that would be at a floating rate at that point.
Yeah.
Okay. And I would agree with that sentiment as far as the interest rates. I think we're gonna start seeing some leveling off, maybe even into the end of Q1 and into Q2 of 2023. So I think that's one of the things that we'll start to see, and I think we'll start to see some of this debt starting to change a little bit too. So, but good, kudos to you on that. How did you end up structuring this deal with your investors? I know you had this other group, but kind of how did you structure that all with your investors?
Yeah, so we had a 6% preferred return, so 100% to our investors until they achieve that 6% preferred. And then we did a 70-30 split until they reached 18% IRR, and then it goes to a 50-50. And then we left it there. So 6% pref, 70-30 split up to 18%, then hurdle to 50-50.
Was it is the preferred return a true preferred return, or is it a preferred return with a GP catch up?
True, 100% to them.
Okay, so 100% to them, no catch up on the GP side, and then it does a straight 70-30 split after the 6% pref up to an 18 IRR, and then it splits 50-50 from that point forward.
Yeah, and that's pretty much the model that we've been doing like we're modeling out moving forward, especially with the A class. You know, we usually do a 6% preferred, and then some of our C class, B class offerings will do more of a 8%, closer to the 8% on the preferred return, but still do the 70-30 split with 18% hurdle.
Okay, great. Can you think of any other issues that maybe came up throughout the process of this acquisition?
Yeah, I think the biggest thing was a big learning moment working with the institutional capital on that. You know, it's I mentioned it briefly, but like the check size is nice. You know, you're having a big check, knowing where that's coming from, but again, there's a lot of, you know, these guys got that capital for a reason. So they have a lot of procedures and, you know, in-house legal that we were dealing with. So there was definitely a lot of back and forth on that. It wasn't just, hey, here's $20 million, you know, we like the deal. So that was a big learning moment there. So other than that, when we were raising capital, that's when kind of the interest rates were changing. So investors were definitely very cautious and the environment, not knowing where it was going. You know, I think now we know that where they are, and we can kind of project out where they're going. So easier to underwrite, but there was definitely some question marks from investors when we first were opening this up. So usually send out an email and you get pretty good subscription, but this one, I was on the phone a lot more, you know, talking to investors, you know, kind of letting them know our thoughts on interest rate environment moving forward. So that was definitely something on this one.
So I have one kind of final question for you, or really two kind of final questions or contrasting questions about this. And first one is what did you find was easier during this entire process that maybe originally you thought was going to be a little bit more challenging?
I think the capital raising piece. We thought like this is a great asset. We're able to double our investors' return. And I think it took longer than we expected. I thought it would be a quick subscription because our previous deal was, but I think the timing on it was definitely, you know, we had some reservations there. And then the institutional piece as well, that was a little more challenging.
And what would you say was a little bit harder than expected that maybe originally you thought was going to be a little bit easier?
I think the institutional piece. Yeah. So I thought we were saying what was hard. So what was easier? Yeah.
The first question was what did you find was easier during the entire process?
Gotcha. Okay. I flipped that. Yeah. So
that's all right.
Yeah. So at the end, it started to get easier after, you know, we had that extension. We started to have more investor calls and kind of work through that. So in the beginning, there was definitely some hesitation, but as we got closer to close, it was a little easier. And you know, obviously the due diligence on this is the physical due diligence is super easy on the 2021 build. Being able to not a huge CapEx. Well, we had $1 million budgeted for CapEx, so that was pretty easy on a $73 million project.
What was the total raised altogether?
It was $28 million.
28 million. And then how much did your group bring in?
We brought in 8
million. Okay. And the other group brought in the rest of the check, right? The 20 million.
Yeah, about 21.
Okay. And how did you split up the GP side of it? Was it you guys still, because you're a main operator, you're keeping all of it, or did you have to give up some of that to this other group that came in, or how did that work?
Yeah, it wasn't like a straight 50-50 split, even though they had majority of the GP. It was an interesting structure with them having the majority of the GP, but us having the majority of the asset management piece, and majority of the decision making, day-to-day decision making. I don't know what it came out to exactly on paper. It wasn't like an 80-20 split on the GP side, like straight the equity was split, but they did have the majority of the GP, but we do have the majority of the voting rights.
Okay. And did those investors, not those investors, but did that one investor, of course, they have investors in their project, but they're able to bring in that 20 million. But the other group that you were dealing with that came in on this project, did they do they have a different structure or waterfall than the rest of the investors?
Yeah, they had their own fund. They are on the, I guess they had their own preferred return. So we were actually at first looking at doing an 8% preferred return. But because they have their own preferred return, they got paid first on some. I don't know what the exact percentage is, but they are up to like a certain percent, and then it goes to pari passu, where we're splitting between the two of us. But they have it structured to where they're getting a portion of the cash flow first before it's split to our investors.
Okay. And what about when you're working with this group? Did they try to cut down on some of your equity splits, or did they cut off some of your fees, or how did they handle that piece of it?
Yeah, so we split that. So we did go 50-50 on the acquisition fee, so they partook in the acquisition fee. But you do see that working with some institutional partners where usually you might have a 2% acquisition fee and they want to see a 1%. So there's some back and forth there. Same thing with asset management fee. Sometimes they'll look at that piece. But they were pretty flexible on those fees. They were actually able to get us, they were the ones that came in with the lower insurance quote, because they had a portfolio. They were able to leverage the rest of their portfolio for the insurance. So that was nice on that part. But as far as fees, we split those down the middle and pretty flexible on those.
Okay. So let's kind of change up the questions at the end here a little bit more, and gear it more towards dealing with institutional groups, right? So what did you find was easier than you had originally expected with working with institutional groups?
I don't know that I thought it was going to be, I think I thought it was going to be easier than it was. So I think the fee structure was easier. I would say that for sure. They were pretty flexible in splitting the fees, even though they brought the majority of the equity. So that was definitely something I was surprised on. Okay.
And then what were some things that maybe were harder than originally expected with working with an institutional group?
The amount of legal that was being involved, versus just, your retail investor. There was a lot of legal back and forth, redlining, our legal, looking at their legal documents. They had their own internal fees too, for them placing the debt and for them placing the insurance. They had some fees that we had to look at too, because they had a lot of, they have in-house legal too. So we had to look at some of those fees too. So that was a little harder going back and forth on those terms.
Mm-hmm. Mm-hmm. Okay. Great. Well, Brian, I have no further questions for you at this point, but really do appreciate you taking some time to be here and sharing some information about this acquisition. Definitely very golden nugget packed, if you will, with different structures and setups from an institutional perspective. How can the listeners reach out to you if they have some further questions for you about this particular acquisition, or maybe just want to follow you further?
Yeah, you could, if you have questions, it's just Brian, BRIAN @elevatecig.com, or you can follow me on social media. It's Brian Wagers on LinkedIn, Facebook, Instagram.
Awesome. Well, thanks again, Brian, for being here and sharing all this information with us. Looking forward to continuing to follow you and your group as you continue to close more deals, and looking forward to having you on a future podcast.
Sounds great, Dan. Good talking to you.
Awesome. Thanks, Brian.